Hello everyone, thanks for listening in. My name is Phil Dettwiler and I'm responsible for digital custody services at SEBA Bank AG in Zug. Today we're going to look at the topic digital assets, how they are being stored and how the storage of those differentiates from traditional assets. There are various ways you can store those assets and we're going to look at those possibilities. First of all, I would like to instill you a sense why security is so important with the safekeeping of digital assets. On the slide I'm showing you here, you see the various issues that can be encountered by digital assets. You certainly have heard about various issues and negative news in the crypto space. Those news usually originate in four categories. In the years 2017 and 2018, they were mainly rogue ICOs, initial coin offerings. There are though also illicit or illegal activities evolving around payment tokens. That means usage of Bitcoin in the darknet or other illegal activities. There are also hacks, and in the hack space we're mainly talking about exchanges. And that is the fourth category, lost keys. What you see on the slide are the various issues with lost funds at exchanges over the various years. Those amount up to 1.8 billion US dollars. That sounds like a lot. But if you compare that to key incidents, which amount up to 30 billion US dollars, this is much more. 30 billion US dollars in lost keys. This is roughly 3 to 4 million Bitcoin, or put differently, about 20% of the outstanding Bitcoin. This should give you a sense of how important the safekeeping of your private keys is so that you're not losing your digital assets. But why is this safekeeping of digital assets so important and how is it different from other financial assets? It is very important to understand that crypto assets are bearer assets. Bearer assets are assets that are owned by the person who holds the access to those assets. So, if you're holding the private keys, you can walk away with those assets. It's basically very comparable to physical fiat money. If you're holding a bill, you can't claim it belongs to someone else, you just take it and walk away. Another very important concept of crypto assets is that they are always stored on the blockchain. We have seen various devices, USB sticks, wallets, etc. And it is important to note that it's not on those devices the digital assets are stored. These devices or means are merely safekeeping the private keys that allow you to access the blockchain. By accessing the blockchain, you move those assets from one address to another on the blockchain. That is why in the industry we hear often the term not your keys, not your coins, which is basically true because only the holder of the private key can move those assets. But wait a minute. It's actually not so different from the traditional finance world. For example, if you're holding a share, that share is not kept in your name with the custodian, but in the name of the bank you're banking with. So the difference is not that big. But for now, the first time you theoretically could be your own banker and handle everything on your own because you can have your own wallet, you can open accounts with exchanges and bank absolutely independently. That is why there is the question, why would you need a bank at all? Very important to understand is the blockchain trilemma. The trilemma says that you basically have a trade-off between security, scalability, and centralization. One of the original ideas of digital currencies was a decentralization, and now with a bank entering the space, you could argue this is being exactly undone. And I see a little bit of a difference or a trade-off between the two components of centralization and security. Because usually a bank can bring higher security to the table, though a little bit more of centralization. Now, if you would like to go to a bank, this is a question of your personal flavor when we're talking about private clients. Institutional clients do have less of a chance to do it on their own because they are restricted with heavy regulation they need to comply with. And these are actually then exactly the advantages a bank can bring to the table. A bank is operating in a fully regulated and regulatory compliant space. We're up to date with all security measures, and the young industry, evolving industry, has a lot of changes also from a security and IT perspective, and it's not easy to keep up with those. But I would also like to mention services a bank can bring to the table. Let's imagine something happens to you and you store your private keys privately or on your own. Your wife, not knowing those private keys, would not stand a chance to access those assets, and they would be simply lost and would fall in the pool of the 20% I was referring to before. So everything together, I think banks can bring a lot of convenience of a one-stop shop to the table. You don't need to onboard with an exchange, you don't need to be your own custodian, you can have products all out of one hand. So having said that, I would now like to briefly show you an overview on the different wallets on the next slide. Broadly speaking, you differentiate wallets between online wallets, which are connected to the internet. They are called hot wallets, and offline wallets not connected to the internet. These are so-called cold wallets. Furthermore, on the hot area, you see various subcategories. Most used are mobile wallets. For example, Mycelium, just to name one. There are also web applications or web-based wallets that are oftentimes used by exchanges. And desktop solutions exist as well, for example, Electrum. What is very popular, particularly for a little bit higher amounts, are so-called hardware wallet. These are gadgets which are offline and on which you store your private keys. These days, a little bit less en vogue and maybe also not the most secure way to store your crypto are paper wallets. They are basically, indeed, as the name says, just a paper wallet. That's a piece of paper with two QR codes on it. There is the public key on it, where you send the money to, and there is the private key on it, that is used to move the funds. And here you see once again why you need to safekeep the private key. When you find that paper wallet, anyone who picks it up can use the private key and move the funds. One last word for clarification. As said before, bear in mind there are no digital assets on all those wallets. It's the private keys that are stored in those wallets. The underlying digital assets are stored on the blockchain. Now let us have a brief look in the custody solutions SEBA is offering. We are very proud of our super convenient and very secure solutions proprietary solutions we build up on our own. Why do we have 3 different solutions? They are different by use case. We offer a cryptocurrency account that is an online or hot solution that tracks the assets on an unsegregated wallet. An unsegregated wallet in the name of SEBA. This is the solution that is used by trading active clients because it allows you to have instant access to your assets. If you would like to hold your digital assets separated in a segregated account, this is in the hot solution the case, that solution would be the right one for you. Both cryptocurrency account and hot solution, they use the same technology. It is a multi-authentication HSM approach which is super secure. If you would like to safekeep your assets long-term and offline, the cold solution would be the right one. This is a multi-signature solution with additional physical and biometrical safety measures. If you have further questions, please drop me a line. I'm more than happy to answer those. Thank you very much for listening in, and goodbye.